Welcome to the show, everybody. I've been looking forward to this one for a while. Today we have Jordan Zinberg, who is the founder, president, and CEO of Bedford Park Capital. Jordan, welcome to the show.
Thank you so much for having me.
So, Jordan, you were awarded the number one hedge fund in Canada for 2024. How does it feel to be number one?
It's a dream come true, to be honest. I was really humbled to be in that room with so many amazing money managers that I've looked up to my whole career. And, last year things really lined up. It was a fantastic year in the markets. Any investor should have done well. We had Canadian bank stocks up 20%. We had the NASDAQ up 30%. And I think skilled investors should have done much better. And we were able to put up phenomenal results for our clients. And, I was really happy because those investors placed their trust and confidence in us. And it felt great to be able to reward them with a really healthy return in 2024.
And what would you say mainly contributed to that outperformance last year?
I think it was a number of things. Obviously, having a great market backdrop was helpful. Over and above that, our portfolio was nice and tight. It was very concentrated. We had a number of names that more than doubled last year. We're going to be profiling some of those names in our upcoming Q4 letter. So I think it wasn't just one or two lucky stocks. The portfolio as an aggregate performed very well. When I was doing my year-end review, I noticed almost every stock we owned outperformed the general markets, and some were up 150, 200%. So it was really a special year. Those years don't come around very often, but when they do, I think astute investors have to go in and make sure they have their capital and their best ideas and stay on top of their companies. And if they do that, you should get some fantastic results. I often say, investing is not easy, but it's simple.
Speaking of that, I got a sneak peek of your Q4 letter, and in that letter you mentioned that, quote, 2004 was an easy year for investors, and it's not always easy. So can you tell us more about that?
Yeah, I think it goes back to what I was just talking about, which is you could have bought almost anything last year and done well. If you looked at 2023, for example, we had very similar conditions in place in 23 in terms of the market backdrop. If you think about what was going on, we had shifting investor expectations about interest rates that were leading to volatility. We had geopolitical tensions that were leading to volatility. But in 2023, the markets didn't do very well. We were fortunate. We actually ended up having a good year that year. But 2024, you could characterize the same way. We still had fluctuating expectations about interest rates. We still had geopolitical issues. We weren't into all the tariff issues that we're into now. So that's a new problem for everybody to worry about. But 2024 and 2023 actually looked very similar. The only difference was in 2024, we had multiple expansion. So we had stocks that in our segment of the market were trading at, let's say, 3 to 5 times earnings that were all of a sudden now trading at 8 to 10 times earnings. So we got great earnings growth out of our portfolio companies. We had investors recognizing the great operating results we were seeing and then rewarding those companies with higher multiples. And the interesting thing from where I sit is even at 8 to 10 times earnings for the types of stocks that we own, companies that are growing at 20, 30, 40% a year, 8 to 10 times earnings is still very reasonable. It's still a very good setup. So a lot of people are talking about how overvalued the US market is. But when you look at our domestic market in Canada, Canadian stocks are trading at a massive discount to US stocks. And then if you drill down even further, small and mid cap stocks are trading at a historic spread to large cap stocks. So everybody's focused on these expensive US large caps, not realizing that there's a ton of gold down in the Canadian small and mid cap area for those who know how to look and what to look for.
Absolutely. So for viewers who are just being introduced to Jordan, that award, I forget the time frame, I think it was June to June, but it was your fund was up 74%, and that's what made you the number one equity fund in Canada. Your full year 2024, calendar year though, I believe you're up 59%, which is still outperformance. And then your 5-year annualized record is 18%, which is phenomenal. So let's talk about how you got started, Jordan. I'm super curious in the story because I know that you were at RBC, but then another guest who was on the show, Jason Donville, you actually knocked on his door pretty early on in your career, and you got hired, and you worked under Jordan for, I believe, under Jason for 8 to 9 years. So tell us about that.
Sure. So I started my career off at RBC as what they still called at the time a stockbroker. Now they call themselves investment advisors, or in some cases portfolio managers. And it was a great place for me to start. I think it's, starting at a big firm for a young person without a lot of industry experience is very good. I made some incredible connections and learned a lot. But through the course of my 20s, I realized that what I really liked doing was ripping apart companies. It wasn't necessarily talking to clients and providing all the ancillary services that advisors are now expected to provide. What I really liked was looking at companies and trading stocks, and I wasn't really able to do that in the role that I was in. So I went out and spoke to a couple people, and I got introduced to Jason Donville, who had just started his firm a little less than a year before I met him. And at the time, it was just him and his partner, Hal Kent, who was more of an operating partner. And Jason needed some help in a number of different areas, and I was willing to help him, and I thought he could teach me a lot of things, and he became an incredible mentor, and we worked together for 9 years side by side. And I like to think I played a key role in helping build the firm. When I joined Jason, it was basically his money and a few other people. We had about maybe $12 or $13 million under management. And then over the course of the ensuing, 6 or 7 years, we grew the fund from that size up to a peak value of close to 400 million, with some excellent performance along the way. And we had a lot of fun, and I learned a lot. And I look very favorably upon those years. But towards the end of my time there, it was always my dream to start my own firm. And as I got into my later 30s, I realized that it was kind of now or never. So in 2018, I decided to leave Donville Kent and start my own firm, Bedford Park Capital.
And so you learned the ropes in the hedge fund world under Jason Donville. You started Bedford Park Capital, as you said, 2018. How are your philosophies, though, different? If you look back to those old DCAM days to Bedford Park, I'm just curious. I'm sure there's nuances.
Yeah, I had obviously a front row seat to see what worked and what didn't work. Especially in the early days, I wore a lot of hats: analyst, trader, a number of other roles as well. So I got to see what worked really well with the strategy, and then I saw some areas of improvement that maybe were a little bit more suited to my way of thinking. So when I compare and contrast the two approaches, we're very ROE centric. That was probably one of the key learnings from Jason. But I think over and above that, I think that our approach has a little bit more flexibility. We have a playbook that includes probably a few more plays or different plays. If we're going to use a football analogy, for example, I think we trade a little bit more. We're a little bit more active. We also have what I call a special situations bucket in our approach that allows me some flexibility to stray from our core sort of high ROE, low PE, high momentum type of strategy. So that gets us involved in some different things, and we found some fantastic investments that sit in that special situations bucket. It can be anything from a high yield bond to a cleanup trade, to a catalyst driven, shorter driven trade. It's not a huge component of what we do. Our core is still those high ROE, under followed, get in early type of stocks that we've become known for, and similar to the approach that I learned under Jason. But I think if I were to summarize the key differences, I would say we're probably a little bit more active on the trading side, and we probably get into a few things that they wouldn't get into. And I've been gone for a long time, so I think they've probably gotten into some different areas as well. But that would be probably how I would summarize the key differences.
Let's unpack some of those special situation plays. First of all, let's talk about cleanup trades. What does that mean, and what's the strategy with that?
Sure. So once in a while, you'll have a situation where you'll have a seller, typically an institutional seller, who's looking to sell a large quantity of stock at one time. It could be because they're changing strategies or managers or just want to change their mind. And in small cap land, it's not always easy to go and sell millions and millions of shares of what could be maybe a small or illiquid stock. So typically what that seller will do is contact an institutional broker who's trades the name, who's familiar with the name, who knows who the buyers are. And then what will happen is we'll get a phone call late in the day, maybe even after market or maybe pre-market, and the broker will say that they have a block of stock ABC. Because the seller is motivated to sell and wants to sell at one time, it typically will come at a nice discount. So in our case, I like to think we know our companies very well. I like to think that we get those kind of calls, and because of our familiarity with the names and our ability to act quickly, we can often go in and buy those stocks maybe at an 8%, sometimes even a 10% discount. So when you talk about a cleanup trade, you're effectively cleaning up the seller, and that's where the terminology comes from.
That's interesting. So that might not be accessible, obviously, to the do-it-yourself investors on the call, but I think the next special situation will be, how do you play spin-offs?
Spin-offs. Spin-offs are interesting. we've had some great ones, and I know you've talked a lot about Constellation Software on your show. So I think that's a great example to delve into. Been following Constellation since 2009. Have actually owned it since then. Wish I bought more back then. But as you're aware, Constellation decided about 3 or 4 years ago to spin off one of their divisions. It was Topicus, and it was their European division. And I saw that news, and I was just very intrigued by it. So obviously we don't get a lot of information from the company directly, but what I saw very quickly was over the course of my career, and especially since, looking at Constellation, I'm often pitched ideas as the next Constellation or the Constellation of this industry. And that's how people, because the stock's done so well, that's how a lot of brokers try to pitch their ideas. Well, I sat back and thought about this, and I said, this really is the next Constellation because it is Constellation. So the other thing that was interesting about that one in particular was we had a very interesting trading situation in place. And what that was a lot of larger institutions who own Constellation shares either couldn't or didn't want to own their Topicus shares. So you had a lot of forced selling in the first few days of trading. And actually, not only that, in the case of Topicus, I recall some of the brokers, I believe it was BMO or RBC, I think it was BMO, were actually trading the stock before the spinoff in what they refer to as a gray market. And I don't know how familiar you are with this type of trading, but what would happen was they would have some of these institutions who knew they needed to sell their stock and sell it quickly, would approach the broker and actually want to trade it in advance of the spinoff. So what would happen is the trade would take place in advance, and then once the spinoff, it had delayed settlement, and once the spinoff took place and the holder received their shares, then the trade would be executed. So we were actually quite active buying Topicus in the gray market prior to the spinoff. We got some very low down. We still hold the stock today. And then the other reason why I think this is a great example is it gets into another concept, which is pattern recognition. And what happened was 2 years later, Constellation had another spinoff. In this case, it was Lumen Group, which we also own. And the same thing happened. I sat back and looked at it and said, well, this is Constellation. In this case, it wasn't a different geography like it was with Topicus. In this case, it was a sector focus on media and communications. And I sat back and thought about it and realized the same conditions were in place, and we'd probably have the same phenomenon with this institutional selling for the first week or so. And that's exactly what happened. We were able to go in and buy stock at, I believe, $16 or $17, and the stock's trading close to $40 less than 2 years later. So a lot of concepts in there, I think, interesting for viewers to think about, which is, spin-offs as well as pattern recognition, which, two key concepts, I think, to be a successful investor.
Absolutely, and there's another tool in your special situations tool belt, and sometimes you'll allocate capital to high yield bonds. Can you walk us through that strategy?
Sure, and I'm by no means a bond specialist, but I think the best example of that is a stock that's been one of our biggest winners over the past couple of years. It's a company called Source Energy, and I can get into the company and how we found it and all of those things later if you like. But as I was looking through the balance sheet, the biggest issue with this company when I first looked at it was they were highly levered. And that seemed to be, of the investors who actually even knew that the company existed, that seemed to be the biggest concern, is that the company had a lot of debt. And like I said, I'm not a debt guy, but I said, okay, well, let me poke around a bit and see what I can find out about these bonds and how they trade, and maybe get an opinion from some of those really smart fixed income guys, because they're supposed to be smarter than us. So I called up a few friends who operate in those corners of the market, and I said, have you ever heard of these bonds? Have you seen these bonds? What can you tell me about them? And what I found out really quickly and really surprisingly is that the bonds were at the time trading at a 28% annual yield. So I sat back and said, well, I'm going to get the return that I like to get from an equity with the safety of a bond. And I decided to look at buying some bonds. And luckily, we were able to find some supply. And I think, this gets into another concept which we can talk about in terms of just access, right? Which is a key for investors in our corner of the market, is access to information, access to product, knowing which brokers to call, which desks to call, who you need to speak to when you want to find something. So I called a couple brokers and I said, I want to buy some of these bonds. And we started buying the bonds. I believe my first purchase was $72.40, if I remember correctly. We started buying the bonds at a 28 yield. And the company just announced the bonds were coming due actually in March of this year. So we've held them for almost 2 years now. And the company announced late last year that they're refinancing all their debt at a lower rate. All the bonds will be taken out at par. So it's going to be a fantastic win for us. in a bond, which is something we don't usually look at. We've probably owned 3 or 4 bonds throughout our 6-year history now, so it's not something we do all the time. But by all means, if it's a company we know well and we like, and I think we can get an equity type return from a bond, I'm more than willing to look at it.
That's phenomenal. Good one, Jordan. I was going to ask about turnarounds and deep value, but I think the case of Source Energy will be perfect for later on in the conversation there. So you mentioned you still do your own trading at the hedge fund. It sounds as like you love the trade. I think viewers be interested in how does a hedge fund manager quietly, stealthily buy up a large stake in a company? What's the strategy?
That's a great question, and I think as a fund manager we have options. We can do all our trading internally ourselves. We can do our trading on various desks, or we can do some combination of those two things. I would fit into that latter group, and I think sometimes it's important to trade on a specific desk. Not only do you want to make sure that you're paying your brokers so that you get the service and you get the calls and you get the ideas and the opportunities, sometimes you want a desk to know that you're buying a particular stock, because let's face it, these desks aren't always very quiet. So sometimes I want people to know that I'm buying something, and sometimes I don't. So that will dictate the strategy and whether I'm trading it internally through my own system or through someone else. Like I said, it's important to pay brokers and have that access, but sometimes you want to be quiet. And I think there's a lot of examples I could take you through where we're dealing with a small company, there's no research coverage, there's not a lot of liquidity, and sometimes I have to go in and buy $50,000 a day. But if I do that for several weeks, we end up with a position of a few $1,000,000. And one of the nice things about running a relatively small fund is those can still be meaningful positions for us, whereas a bigger pool of capital may look at some of those companies and say, oh, this is too illiquid, I can't buy this, and they end up missing those opportunities. So getting back to your questions, I think it's highly strategic in terms of, do we want people to know what we're doing? Do we not want people to know what we're doing? Like I said, still making sure we support our brokers because they're a key part of our ecosystem. And then the other thing is when you trade on a desk and a certain broker knows that you trade a specific name, there are advantages to that. And the key advantage is if a broker knows that we will actively buy or sell a certain stock, we will get the call when they have stock that's available to either buy or sell. So one of the nice things about being in the flow with various brokers is you're kept up on your names. Even if I don't want to trade a name, it's very helpful to me to know that there's a big buyer out there, or maybe there's a big seller out there. Maybe I was about to buy some stock and I find out that there's hundreds of thousands of shares for sale already, so maybe I'm holding off. So I think a key part of the skill when it comes to trading is knowing when to be quiet and when to be loud, and making sure, like I said, that you're evaluating each situation based on those ideas and understanding when you want people to know what you're doing versus when you don't.
It's all strategy. That's really interesting. A little bit of fun here. So you're one of the best guests on BNN, obviously. You're one to watch, along with Jason Donville, Jason Del Vicario, and others. You have a fan base, it sounds like. We've talked about this. I'm pretty sure it's a group of grandmothers in a retirement home out in the Maritimes. Can you tell us more about that fan base?
Yeah, BNN is an interesting thing. The viewers are very rabid. I've had people come up to me in airports. I've had people come up to me at restaurants. I've had viewers contact me and try to set me up with their daughters. The group you're alluding to, apparently there's a group of ladies who like watching me, and they bake cookies and get together and watch my appearances. So, one of the great things about BNN, not only from the exposure, is I get to connect with interesting people from not only Canada. I actually spoke to a fund manager in Spain the other day who saw me talking about a stock on BNN, and it piqued his interest. So it's a great platform, not only for meeting people, but for getting our ideas out there, and even giving our investors who are already invested with us an update. I know some of our investors barely call me because they say, oh, you go on BNN every quarter. I kind of get an update on all our names, and that's enough for me. So it's been a great platform. I enjoy doing the show. And yes, we do have some interesting fans, and we get some interesting emails always after the show.
Of course, and there's always that question. I was actually disappointed not to hear the question about A&W or Pizza on your last appearance, but it's bound to happen next time. So for viewers of the show, let's get to know your strategy, Jordan, for how you select and how you invest in the fund. You mentioned return on equity, and that was really under Jason Donville. Really hit that home. Like that should be the center point for companies. High return on equity. But Also, you concentrate on valuation, you concentrate on share price momentum. Can you just go through the whole kind of qualities in companies that you look to invest in?
Sure. Sure. So at a high level, our strategy is actually very simple. It's not complicated at all. What I'm trying to do is look through the Canadian market and see which companies are growing the fastest. So if the way I break down the Canadian market is we're typically looking at companies for us between 100 million and 5 billion market cap. So that's that kind of small mid area. That's not to say that I won't look at large caps. And in fact, we do own a few large caps, but typically I'm looking for companies that I think can grow at 20% a year or more consistently. And that last word is important, consistently. So I don't want a company that grows 25% one year and then 4% the next year. That's not what we're looking for. I'm looking for that nice, high, consistent growth rate. Yep. Now, the first question is, well, how do you measure that growth rate? Are we looking at revenue growth? Are we looking at earnings growth? What are we looking at? Because there's a number of different measures that we can use. So in our case, we look at return on equity. Quite simply, I think that's the best way to judge a management team's ability to allocate capital. So if you think about what's actually happening with a company is given a certain amount of capital, and then the management team decides how to allocate that capital, and they earn a return based on how they allocate that capital. And it's actually not dissimilar to a fund manager, if you think about it. CEOs are almost like fund managers. They're entrusted with capital from investors. They make decisions, and then they're measured on the returns of that capital. So for me, if I look at 3 different management teams and they all have the same amount of capital, but one is earning a much higher return, that's obviously the company that I want to speak to. Now that in itself is not rocket science. I mean, Buffett's been talking about ROE for years, for anyone who's been paying attention. The problem is that everybody wants those stocks, right? Who doesn't want to own stocks that grow at 20% a year or more consistently? So when you get to the next step, which is valuation, oftentimes a lot of those companies are trading at very high multiples, and sometimes they deserve those multiples and sometimes they don't. But that being said, what I'm trying to do is sift through all those high growers and say, which of those high growers are not on high valuations and why? And when we find those high growers that are on, I'm going to say, reasonable valuations, we don't expect distressed valuations, although we do get that sometimes, which is great. But I'm going to call it a reasonable valuation, and I'll tell you what that means to me in a minute, is why is it available to us at a reasonable valuation? And there could be a number of reasons for that. One of the key reasons in our case is the company can just be small. Sometimes the company is small, and bigger pools of capital, bigger funds and ETFs just can't buy the stock. So that's reason number 1, it's just small. Reason number 2, it might not be small, but maybe it's not very liquid. We have a stock in our portfolio where the CEO owns half the company and it's a 2 billion market cap. That stock is large, but it's not very liquid. It's hard to buy. So again,
Mainstreet equity?
how did you know?
Okay.
How did you know? Fantastic business. We can talk about it later on if you want. But a great example, that's not a small company, but it's just not very liquid because the CEO owns half the company. And me personally, I love that. When the CEO owns half the company, I love huge insider positions. And that's something I'll get to in a few moments. But let's go back. So we've got a high grower. It's on a low valuation, either because it's small or liquid, or it could be in an industry that people just don't like or don't understand. I mean, our biggest position, Propel Holdings, is an online non-prime lender. Most investors don't love non-prime lenders. Most investors don't understand them. Most investors are so full of bank stocks that they don't think they need to own any financials, but they're actually missing a ton of gold in that non-bank financial space. And we can talk about Propel more specifically if you like later on, but there's one where the industry is not particularly well liked. And in the case of lenders, the accounting is a bit complex. It takes a little bit of time to understand the nuances of their accounting. So those are some of the reasons why we're able to find these high growth stocks that for one reason or another just aren't trading at the valuations they deserve. And what we're trying to do is find those stocks early, get up to speed on them, build a relationship with management. And if those key components are in place, along with, I mean, that's our basic screen. Obviously, we're going to do all the other diligence you'd expect us to do in terms of building a model and seeing the operations and getting to know management and looking at competition and you know, all the things that everybody does. I'm not going to say that I'm unique in doing those things. That's standard procedure for any investor. Once we go through that process, if everything checks out, we'll typically start with a small position, and as time goes on and we get more comfortable and we see the company performing and we see the stock performing, we'll generally add to that position over time. So that's a very high level of sort of the key building blocks of what we're looking for. There's some other things as well in terms of some share price momentum. We like to see insider ownership. reasonable debt, those types of things that you would expect. But the cornerstone of what we do is trying to find these high growth stocks that for one reason or another haven't really been appreciated by many other investors yet. And then once we have our position, to start and go spread the word. So write about those companies in our letters, go on BNN, top pick those companies, and do everything we can to support the companies. And in a lot of cases, we become a bit of a trusted advisor for some of the CEOs. And the reason is they've got brokerage firms in their ear all day trying to convince them to do things, to raise money, to buy other companies. Sometimes these CEOs just like talking to somebody like me, where my only interest is seeing the stock go higher. That's it. That's all I want, is for the stock to do well. I'm not trying to sell them anything. I'm not trying to convince them to do anything. So I get calls from CEOs sometimes where they're just saying, hey, we're thinking of either bumping our dividend or buying back stock. What do you think? Or, things like that, where we can be a sounding board and just use our capital markets experience to help these CEOs as well. So those would be the basics in terms of the things that we're looking for.
That's interesting. And these smaller financial services companies, for example, Propel, Goeasy, have basically become a sweet spot for you, Jordan, and generate a lot of alpha in the fund. Going back to your example of return on equity being so important, but consistent return on equity year over year being more important, but the magic of Propel, you wrote about this, the case study of Propel Holdings, is that their return on equity actually doubled within, I think, 2 to 3 years. It went from like 22% to 45%. How does management make that happen? That's phenomenal.
So in Propel's case, I think what you're talking about, the ROE was actually over 100% before they went public. And then when they went public, they raised, I believe it was $60 million. So that when they brought in that new equity, it actually dropped their ROE because their equity base was higher. So it wasn't that the business wasn't still growing at a very healthy clip. It was just that the denominator in that calculation, the E, so to speak, was much higher. So their ROE took a step back for a year, and then as they absorbed that equity, placed it out in new loans, and were returning or earning high returns on that capital, their ROE recovered. And I mean, Propel is a great example of exactly what we look for. This was a company where it came public. It was in a hot market in 2021, and then when the market died, everybody just kind of left it for dead.
Yeah, it was flat for 3 years. Left for dead.
Yeah, I was sitting there like a kid in a candy store. I mean, I'm looking at this company that's doubling their earnings every year. At one point in 2023, you could have bought that stock on 3 times earnings with a 6% dividend yield. And I'm looking around going, what am I seeing here that nobody else is seeing? And am I wrong, or is everybody else wrong? I had brokers calling me every day trying to sell me stock at $8, and nobody wanted it.
No one wanted it.
Now the stock's at $37 and everybody wants it.
Yeah, of course. That's really interesting. And so that return on equity still has room to grow. It still has room to go higher. It's at around 45% now, potentially.
Yeah, I think a normalized ROE for this business is going to be around 30-40%. Obviously, the company's grown quite a bit. It's around $1 billion market cap now. They did raise another $100 million of equity last year to go do their first acquisition outside of Canada. They bought a company in the UK. But the interesting thing about ROE is a component of that is what I like to call managing the E. Yep. And I think managing the E is important because, CEOs are often being offered money left, right, and center by various investors. And some people say, oh, well, when the money's available, you should take it. Well, a smart CEO doesn't think like that. A smart CEO actually manages their E, because if they have too much capital that they don't need, that ROE is going to be low. So what do you do with that excess capital? Do you buy back stock? Do you issue a special dividend? Do you go buy other companies? So I think ROE is a very simple calculation. Managing the E, which is the CEO's job, is not as easy.
Yeah. So another case study that we can explore, again, in the smaller financial services space, Goeasy. I think the announcement was made recently that the current CEO is stepping down. As a hedge fund manager, someone with stake in Goeasy, what do you do? What's the decision process here when the CEO is leaving?
Sure. So Goeasy is a name I've followed for many years, owned for many years. We've owned it since day one in our fund. Just to set the stage, for those who aren't familiar, non-prime lender in Canada, multi-channel. They do lines of credit, they do installment loans, they do second mortgages. A couple of years ago, they got into auto loans, and now this year they're getting into credit cards, which is another huge opportunity for them. So this company has one of the best consistent track records of ROE in Canada that I could show you. This company, like clockwork, does 20 to 25% ROE every year. and the multiple tends to jump around a lot. I mean, in COVID, this stock got down to 3 or 4 times earnings, and then off the bottom from COVID, it almost 10x'd off the bottom. So this is a volatile stock. It's not for the faint of heart. Once you understand the business and how strong their platform is, you really understand what a great investment it is. And believe it or not, we have a slide in our one of our presentations where we compare Goeasy to Royal Bank, and the Royal Bank guys don't like this slide very much. I happened to present it in an RBC office once, but what it shows is that Goeasy has dramatically outperformed Royal Bank over time. And the reason for that is quite simple. RBC has an ROE of, call it 8 to 10% plus their dividend. Goeasy has an ROE of 20 to 25% plus their dividend. So even if there's no change in the multiples for a long period of time, you'd expect Goeasy to double at least the performance of RBC. So a lot of these non-bank, non-prime lenders are really misunderstood and underappreciated. So I just wanted to kind of set the stage in terms of what the company looks like for those who aren't familiar. But getting back to your question directly, I was really surprised. The CEO who stepped down, Jason Mullins, is a relatively young guy. He's probably somewhere around 40. He was given the chance to run this company in his mid-30s, which just tells you how much confidence the board and the management team had in him. He was an excellent CEO. Shocked and surprised when I found out. So I picked up the phone and called him, and we had a conversation. And you know, he's been great to me over the years. He actually came and did a dinner presentation for a bunch of our investors last year. And I talked to him about strategic things, and you know, him and I had a very good relationship. So I was really surprised, and I won't get into, you know, some of the details that he provided me in terms of what had happened, but he decided to step down. And you know, I think when that happens, to your question, you have to really think about a couple things. You have to think about how strong the business is on its own, how important that CEO is to the day-to-day. You know, how big is their team around them? Do they have only 1 or 2 lieutenants? Do they have 5 or 6 key people? And then the obvious question, which is who's going to replace him? And they've been looking for a replacement for quite some time. They haven't found anybody yet who they're happy with. So the former CEO, whose name is David Ingram, has stepped back in. He's been chairman of the board for many years. He's stepped back in as CEO. I can tell you I'm extremely comfortable with him running the company. I don't know how long he'll do it for. I think it's just sort of a temporary thing, but he was the CEO for years. He's been the chairman for years. He has a big position in the stock himself, which, as I alluded to earlier, is something I like to see. So I'm very comfortable with him running the company. In terms of who they end up hiring, I'll evaluate that person once I meet them, but I think the platform is strong enough and the business is strong enough that although disruptive and I wasn't happy to hear about it, I think the company will be just fine over time.
That's just great, because there's a misconception, Jordan, and you've written about that most people think that, you know, hedge fund managers especially, they're, you know, super active in the market, and that the best money managers are active money managers, but that's just not true. Like, you don't take, you know, selling decisions lightly like that. If you have your initial thesis, very seldom will you sell, right?
Yeah, I mean, we will trade around a little bit sometimes. So let's say I come in on a given day and one of our stocks is up 10% on no news. I might poke around, and if there's no reason why, and I determine it's basically just a buyer in the market who's just really anxious to get their stock and pushing the stock up, and I know once they're done, the stock's going to drift back down, I might give them a little stock. Same thing on the flip side. If I come in on a given day and one of our stocks is down a lot, and I investigate and there's no real fundamental reason, maybe it's just a big seller in the market, maybe we'll pick up some stock and flip it out later. So we are active in terms of trading around little pieces of our core positions, but we're not trading the entire position. So to your point, I think, you know, based on what people see on TV or movies or just misconceptions, they think that we're coming in the morning and buying something and trying to sell it in the afternoon and make a quick return. That's not at all what most managers do. There are some what we call fast money guys who do have shorter trading windows. That's actually a really hard way to manage money. And the reason I say that is if you're only making 5 to 10% every time you buy or sell something, and then you have a couple mistakes, you're not going to do well over time. So I think if we look at one end of the spectrum, which is, you know, buy and hold and go to sleep and don't do anything, and then the other end of the spectrum, which is complete fast money, momentum, in and out trading, I like to think we sit somewhere in the middle. So we'll hold positions for a really long time as long as the thesis is intact. And what I mean by that is the company's still growing at a very healthy clip. The valuation hasn't gotten extreme. Everything else is going well. But at the same time, I think we've been able to augment our returns by intelligently trading around some of those positions. Because let's face it, some of these small cap stocks, they do bump around a little bit, and there are opportunities. I did a post-mortem on a position that we sold last year, and the return on the stock was, I believe, around 60% through our holding period. But because of the incremental trading we did, our return on the position was actually 80%. So it is possible to augment your returns with intelligent trading, but I'm not talking about trying to make 1 or 2%, because we also have things like taxes to think about for our investors. If you bought a stock at $1 and it's at $10 and you go and sell it just to clip 4 or 5%, well, you're now taking a huge gain for your clients. So we're mindful of things like that too. I mean, tax doesn't drive investment decisions, but we are mindful of that. I think the key is to own your names, hold your names, but don't go to sleep on your names. I think that's really the message.
So 2022, and the viewers on the show who are invested in the market, 2022 was a tough market for everybody. For do-it-yourself investors, for mutual fund managers, hedge fund managers like yourself. It was hard. Can you walk us through the challenges then, Jordan, and how in 2023 you turned into a much more concentrated portfolio, and it was because of all the opportunities as a result?
Yeah, so if you look at what happened before that, so we launched the firm in late 2018. We had a good year in 19. We had, despite COVID, we had some really good years, 20, 21, 20, we were up 35-ish% back to back in those years. The firm was growing. We had great momentum. And then all of a sudden we get into this really tough market in 2022. And the interesting thing about 2022 is it wasn't that the companies themselves were actually doing that poorly. What had happened was you just had all this fear in the market about rates going higher. So the companies were still recording very good operating results, but we had multiple compression. So it was the opposite of what we had in 2024. In 2024, people decided that instead of 5 times, they could pay 10 or 12 times for stocks. We had the reverse happen in 2022. So we had stocks that might have been trading on 10 or 12 times that went down to 5 times. So it was very frustrating because I felt like I had done a good job picking the stocks and the stocks were performing, but the market gods were just deciding that, we were going to see contraction in multiples those years. And I think the way I've said it before, and I think the best way to characterize how I felt in 2022 was I felt like I owned the best houses in a bad neighborhood. That's really how I felt. And then towards the end of 22, something interesting started to happen. I was sitting looking at our book. I remember it was probably around September of 2022. And at the time we owned, I believe, about 23 or 24 stocks. And I was looking at some of our highest conviction names, like a Propel. I'll use that example since we've already discussed it. And the stock had gone from, call it $14 to $6 or $7. The company was still growing like crazy. Results were good. And I'm sitting there saying, okay, this stock's on 3 times earnings. There's absolutely nothing wrong with the company. So I want to own more of that. So the thinking was, why do I own my 23rd best idea when I want to own more of my best idea? So I made a pretty big decision at the beginning of the last quarter of 22. I sold our lowest conviction names. So we went from 23 names down to 16 names, I believe it was, piled all the money from the proceeds into our best ideas. And what that set up was, a very good 2023 for us. Most of the returns in 2023 came in the back half of the year, but that repositioning that we did throughout late 2022 and into early 2023 really set us up. So sometimes it's what you do before the market runs that's really important. And if you don't do those things in time, once the market's already running, you can be left out. Even if you decide to go to cash, which I don't advise people to do unless they really think they can time the markets. I haven't met a lot of people who became rich from timing markets, but I think knowing what your best ideas are and then having conviction with those ideas, and you and I have had conversations about this before, concentration can be a very powerful tool for investors if they know what they're doing. Concentration can be a very dangerous tool for investors if they don't know what they're doing. But in our case, I feel like our investors are paying us to put money in our best ideas. They don't necessarily want me to buy our 25th best idea or our 40th best idea. They want our money concentrated. And I've always run money that way. And I think unlike a lot of investors, I'm actually more comfortable when I'm concentrated. I'm more comfortable when most of our capital is in our top 10 names. And typically about 80% of our fund will be in our top 10 names.
Yep. Even Buffett to this very day, I think in Berkshire, like at one point, Apple was just huge, is highly concentrated in in the stock portfolio. So yeah, the most successful investors have been concentrated, you can argue. For the next bear market, because as we know, bear markets never go away. It's going to come. We just don't know when. What hedging strategies do you employ to help through those volatile times?
Yeah, so we have a pretty open mandate. We can pretty much do whatever we want. We can short the market, we can use options, we can go to cash. We have a full toolkit, so to speak. I think a lot of people think that our job is as a fund manager is to predict those downturns, and they want all the upside when the market's good. They want our 60% returns. But then when the market's bad, they want us to know that we have to be in cash right before the market turns bad. And then they want us fully invested again when the market turns. Unfortunately, like the world just doesn't work like that. I don't actually think that my skill is predicting that downturn and using those tools ahead of that to position us. I think my skill is actually looking at all the companies in Canada and figuring out which ones best meet our criteria at any given point in time. So the answer to your question is we will use those tools in certain time periods when we're nervous, but I'm not someone who goes and makes those big sweeping decisions. We're out of the market, we're back in the market. I think that's really, really, really tough to do. You can't just turn on a dime like that. So unfortunately, particularly with our strategy and other strategies, sometimes the answer is just to stay invested and tough it out. And I've seen it many times in my career and twice since I started Bedford. I mean, if you look at our results in 2022, or 2020, excuse me, we had the COVID drawdown. And then coming out of that, I think the fund was up something like 15 months in a row, and we were up something like 140% off the lows. So wow. I think sometimes investors just have to be able to take those downturns and hold through them. And as long as you own quality companies and the right things, you're going to be okay coming out the other side. The idea that someone like me can just sit and know the day before the market's going to go down and know the day before the market's going to go up and be shifting around the portfolio appropriately, I just think that those are fairy tales. That doesn't exist.
It really doesn't. So we talked about smaller financial services being a sweet spot for you, but another sweet spot, and this is more recent actually, is Western Canada. So talk about why you're seeing opportunities and investing in opportunities in Western Canada.
Yeah, and this wasn't deliberate. This wasn't really a macro view where I said, oh, I think Western Canada is going to do well because energy is doing well or because of reason A, B, or C. A couple of years ago, I was just looking at the book like I often do and just kind of staring at the portfolio and saying, wow, we own a lot of companies based in Calgary. It hadn't hit me before. And I hadn't been out to Calgary for a while. So I decided to get out on a plane and go in and visit everybody and actually see what was going on the ground in Calgary. And I was really surprised. I mean, I went to Calgary, I saw cranes everywhere. Economy was buzzing. And as we know, Calgary and Alberta is really a boom bust type of province. You can tell what's going on just by oil and gas prices. But these weren't just energy companies. These were companies like you mentioned Mainstreet earlier, which is a fantastic business that still to this day is not very well known in Canadian markets, and that's despite being a much larger company. And part of the reason in that case specifically is it's not a REIT. It doesn't pay a dividend, so it's not like most of the other companies that people think of when they think of apartment buildings. But Western Canada has no rent control. So if you're going to own a multifamily apartment company, do you want to own one that's based in Ontario, or do you want to own one that's based in Western Canada? So there's a number of energy services firms that we like that are based out there. So I think it was really more of a coincidence. It wasn't a conscious decision to say, oh, there's a ton of great companies in Calgary. It was more we had selected the companies, and then it kind of hit me, and I said, wow, we have about 5 companies based in Calgary. We've never had that before. So I think especially if you look at what's going on politically in Canada and the US, I think it's a very positive backdrop for energy. I think it's a pretty positive backdrop for Western Canada. But that being said, I don't really take any top-down views. So I don't say, I like Western Canada, let's go find some companies. Or I don't say, I like energy services, let's go find some companies. I really like to let all the companies compete for my attention. And if they happen to be in Calgary, or they happen to be energy services, or they happen to be anything else, I mean, it's really letting the numbers and the business speak to me as opposed to where they're located. But yes, to your point, for the first time, we do own a number of names that are based in Calgary.
And so I think, for people who would ever meet Bob Dhillon, the founder and CEO of Mainstreet Equity, they'd probably buy shares on the spot. Can you tell us, Jordan, about that experience meeting Bob and why, he's a perfect example of an exceptional CEO in Canada?
Yeah, this is a great story. So I got a call during COVID. I believe it was during COVID. It was around 2019, 2020. I got a call from somebody I knew in Calgary, and they said, "I want to show you a private investment, and it's a real estate company, and they want to go up and start buying apartment buildings in all these small little towns. Not Vancouver, let's say, but the suburbs of Vancouver, so on and so forth." And they said, "Really interesting guy. You got to meet him." They said he's going to be in Toronto, and can we bring him by your office? And I said, "Sure." And so they come in, and let me say, I don't think I've ever bought a real estate stock in my career, aside from maybe from my mom's account. So the problem with real estate companies, as you know, is most of them are REITs. Most of them pay out almost all their cash flow and dividends, and most of them are constantly raising new money, not only to support those dividends, but to do acquisitions. And Bob showed up in my office, and I didn't even really know Mainstreet at all. I'd heard of it, but because I'm not a real estate investor, I didn't know anything about it. So he was trying to do a secondary kind of private deal, and he used his main company, Mainstreet, as his case study to show what he had done. And for those who don't know Mainstreet, maybe I'll just talk about it quickly. Bob was a law student and started buying apartment buildings in Edmonton. This is back in the late 90s, early 2000s. And by the time he finished law school, he had amassed a portfolio of a couple hundred doors and decided he didn't want to be a lawyer and he wanted to go into the real estate business. And he ended up going public in 2002, I believe. The stock was $1 a share. And from that time frame, so let's call it 22 years, the portfolio has gone from a couple hundred apartments to now over 18,000 apartments. And I believe he's going to close in on 20,000 apartments this year. That growth is really impressive. But here's the most impressive part of the story. He's raised no equity in order to do this. Zero. The share count is exactly the same as it was 20 years ago. And I don't know if we can find many examples of that. So it's gone from a very tiny company to a $2 billion market cap, raised no equity. And unlike most real estate businesses, what he's done is taken all the cash flows and reinvested those into more properties. And he's used very cheap financing from CMHC, or for those of you who are watching in the US, this would be like our equivalent of Freddie Mac, Fannie Mae. So borrowing money at 3%, going and buying buildings. And then the other key is the markets that he's operating in have no rent control. Here in Ontario, we have rent control. You can typically raise your rents 2 or 3% a year. Well, when I was in the Mainstreet office last year, they told me they were raising rents 10 to 12% at the time. So not only do we have no rent control, very cheap financing, and a CEO who's constantly recycling his capital, we have him focused on a market where institutional players don't really go. So the big Canadian pension funds are not buying an 80-unit apartment building in Edmonton. So he's competing against mom and pops, but he's very well capitalized. He's willing to transact very easily. Maybe I'll just tell you one of my favorite Bob stories before I get back to answering your question. When I was in Calgary with him, he decided to drive. I had asked to go see some properties. So we got in a minivan. The driver was the COO. The CFO was in the back seat, and then me and Bob were in the middle seat. And we drove around for 5 hours looking at apartments. And I can tell you, I learned so much on that tour, not only about how the business runs, and I had owned the stock for 3 years at the time, but just how Bob is as a person. And here's the story I wanted to tell. We were looking at a building, and all of a sudden Bob says to the CEO, pull over. And we pull over, and he's looking at something on the building, and I didn't know what he was looking at. And I soon came to realize what he was looking at. There was an entry to the building. It was about 5 p.m, so it was still light out. And there was a light on above the door. There was a single light bulb that was on, and Bob was upset. And Bob turned around to his CFO, and I can't remember the name of the person that he said to call. He said, call so-and-so immediately, find out why that light's on. And it really struck me that here's the CEO of this $2 billion company, and he's concerned and upset about a light bulb. And I think that tells you everything you need to know about Bob. But getting back to your question, so we're sitting here in the office, and he's talking about what he wants to do, and he's showing me Mainstreet as his kind of proof of everything he's accomplished. And I'm sitting there going, wow, I think I want to buy Mainstreet. I don't think I want to buy this new little private. I said to him, why don't you do what you're doing inside Mainstreet? And I think ultimately he's ended up doing that to a lesser extent, particularly given at the time Mainstreet was trading at a huge discount to book. So he came in to show me something. Through the course of that, I ended up learning about Mainstreet and just really started to appreciate the company. And we started buying the stock. I think originally $50 was our first purchase on MEQ, and it's trading around $200 now, and it's become a top 5 position for us. And I never thought I'd own a real estate company in my top 5 or 10 names, but this is just a special case, and it's a great example of some of these companies that don't get the attention they deserve. And why doesn't he get attention from the brokerage community in Canada? Because he doesn't raise money.
Yeah.
He's a self-financed business. He doesn't need brokers to raise him money. And I think that's something that a lot of people don't realize is some of the best companies in Canada don't have analyst coverage or have very little analyst coverage. And it's not because they're bad companies. It's actually the opposite. It's because they're the best companies.
Absolutely. And I'm also a shareholder in Mainstreet for all those reasons. If I were to write like the Outsiders for Canada, the Canadian edition, he would be in the book. Absolutely. So staying in Western Canada, you wouldn't invest in any junior oil and gas or mining, right, Jordan? But you do invest in the services companies that service these industries. And so why would you invest in still be in the space, but not directly?
Sure. So let's first talk about why I wouldn't buy a producer, and then let's talk about why I would buy a service company. So it's funny, when I talk to investors outside of Canada, they have this perception that everybody's here is a resource expert and that really they want to come here for resource stocks. And that is true, that you know, Canada is known for resource stocks. And let's face it, US investors aren't coming here to buy our tech companies. Okay, let's be real here. So in order to invest in energy or mining, I think you have to have a very strong view about the underlying commodity. It's not like a regular business where you can just go in and look at their revenue and their margins and make typical judgments. The difference with energy and mining is if the underlying commodity isn't doing well, it's very hard for the stock to do well. So I think using first principles, if I sit back and say, well, I'm not an energy or mining specialist, I don't really have a strong view on where the underlying commodity is going to go, it's very hard to then invest in those sectors and do well if you don't have that view. And let's face it, if you're not right about that view. So I'm not a resource specialist, never have been. And I think part of being a good investor is just sort of knowing your limitations and knowing what you're good at and what you're not good at. The problem is being an investor in Canada and running a fund where your numbers are compared to other fund managers. Resources are such a huge part of our domestic market that if you don't own any resource stocks at all, you can easily be left behind in certain types of markets. So I think it's important to have some exposure. So how do you get that exposure? Well, you can look at things like royalty companies, for example, or you can look at things like service companies. And in my case, I'm much more comfortable with the service companies because if you look at what a lot of these energy services and mining services companies do, they're very much like regular industrial companies. You know, they're renting equipment, they're doing things like that obviously they're going to be impacted by the commodity cycle and by the performance of the underlying commodity, but to a lesser extent than, say, a direct producer. In the case of energy services, we've had some massive wins over the last couple of years in that space. It's really been an out-of-favor space, but you can still find profitable energy services companies trading at, in some cases, as low as 2.5 times EBITDA. And those will change with a cycle. And I think, particularly if we get a new government in Canada, I think you're going to see energy do pretty well, and I think you're going to see the service stocks do very well. But those are stocks that I would say you rent. You don't own them forever. You rent them. You catch them at the right time in the cycle. You get maybe a double or a triple out of them, and then you try to be out before the cycle turns. So a little bit different in those areas than some of the other stocks we own, where, you know, I hope to own Propel for the next 10 years. I doubt we're going to own our energy services names maybe even 3 years from now. But when they turn, because a lot of them have some leverage, you can make some excellent returns. And we actually own a couple mining services stocks too. There are some great companies out there that we've been able to find over the last couple of years.
In the case of Source Energy, being one of the services companies to the industry, you wrote, I believe your newsletter was titled "May the Source be with you." You had so much conviction around Source Energy, but it was basically left for dead at one point. So walk us through that process and how you gained so much conviction.
That's another good story.
Yeah.
Starts kind of the same way as the Mainstreet story. So I get a call from somebody in Calgary that I trust, actually a former energy analyst and one of the investors in our fund. We've got some great investors in our fund that have provided us with some great ideas, and called me up and said, hey, I want you to look at this company called Source Energy. And I said, I've never heard of it. What do they do? And he said, they're a frac sand producer. I said, okay. So I pulled it up on my Bloomberg. I remember the stock was trading about $1.50 at the time. I believe this was late 2022. Late 2022. I pulled out my Bloomberg. It's a 30 million market cap with 160 million of debt. The chart looked like this. The chart was a disaster. And I said to him, why am I looking at this? This is a 30 million market cap with a ton of debt that nobody wants. And he said, do me a favor, take a meeting with the company. Trust me, I think you're going to like it. So I was very apprehensive for obvious reasons. And I sat down with the company, and what they explained to me was something really interesting that I didn't appreciate, which was during COVID, everybody stopped drilling. And when you stop drilling, you don't need frac sand. So the price of frac sand had collapsed. And in the case of Source Energy, the way that they operate is they tend to sign 2 to 3 year contracts with their customers at a fixed price. So they do sell some sand at spot price, but most of their sales are to the big energy companies in Canada at a fixed price. So they had a bunch of contracts come up in 2020. The sand price was very depressed because of COVID. They signed these 2 year contracts at very low sand prices.
Yeah.
Well, now all of a sudden in late 2022, guess what was happening? The contracts were coming up for renewal, and the sand price was more than double where it was when they signed the previous contracts. So I said, that's kind of interesting. So I said, so what you're telling me is you're going to sell the sand for twice the price, but your cost structure is going to stay the same. They said effectively, yes. Obviously, there's variable costs involved. But I said, okay, now I'm interested. And I said, so tell me what you guys want to do over the next couple of years. And they said, well, we want to continue to re-sign our customers at higher prices. We want to work on vertical integration, so actually getting the sand out to the site in a very effective way for the customers. And then our key focus is paying down our debt and refinancing our debt at a lower rate. So now the thesis started to come to me as we were sort of talking about this. I said, okay, you have a company that's going to, sell their product for a much higher price. Their costs aren't going to change very much. They're going to work their debt down. And at the time, this is a really interesting fact. I was talking to them and I was looking at the analyst numbers for the next year, and the analysts were looking for 100 million of EBITDA the following year. So we had a 30 million market cap with potentially 100 million of EBITDA. Well, now I was starting to get really, really, really interested. So I just did a deep dive. I learned everything I could about frac sand. I learned everything I could about the company. We started buying stock right around that $1.50, $1.60 level. We bought the bonds not long thereafter, as we talked about, off the top of the podcast earlier. And then again, nobody really wanted the stock. I couldn't really go and buy huge blocks. I was buying 30,000 shares, 50,000 shares, sort of some days 5,000 shares. I mean, whatever I could get my hands on. And over time, we built a position close to 10% of the company. Got to know the business very well, got to know the team very well. I think I top picked it on BNN the first time at $3, and I said it was going to be a double or a triple. And the next time I went on, it was around, I think, $8, and I picked it again. And believe it or not, I just top picked it earlier this week again at 14, because despite the stock going from $1.50 to $14, it's still trading at about 2.5 times EBITDA, about 4 times earnings, and a very nice ROE profile. And not only that, this huge $160 million debt was refinanced last year at a lower rate with maturity out to 2029. So they've completely de-risked the company now. They've completely de-risked the balance sheet. They're saving money on interest. The setup for the company is incredible. And I guess another interesting little fact here is there was a takeout of a similar business in the US last year by private equity, a similar sand business. And if we impute the valuation of that transaction on Source, we get a share price north of $30 a share. And the stock's sitting here trading, right around $16 right now. So Source is now a very large position in our fund. It's been about a 10 bagger since our initial buy around that $1.50.
Is that your best performer on record ever for Bedford Capital?
I'd have to go back through the archives and think. It would probably be our best performer over such a short time frame, for sure. We've had some other really big wins in the portfolio, And we didn't buy all our stock at $1.50, $1.60. To be fair, we were buying, all the way up. But yes, to get a 10 bagger in a year and a half, this is like, the things that fund managers dream about at night when they go to sleep. So it's been a great story. It's now a few hundred million market cap. It now has a little more analyst coverage. It's getting on some more radars. And I think the stock's going to continue to move higher because not only have they de-risked the business, we now have LNG Canada coming on, which is going to really boost the demand for sand.
Yeah. That's just amazing, Jordan. Dream come true, and you made it happen. So you obviously have a very disciplined approach, and for these underfollowed companies, let's say sub 300 million, it's not very smart to invest in anything that's not profitable yet. But I'm sure there's been instances throughout your career at Bedford where you had an itchy trigger finger. You had such strong intuition for a company, and there's a path to profitability, but of course you have to pass on the company. Can you walk us through that? And how do you finally enter these companies? Is it as soon as they're on the cusp of profitability? Like, walk us through that.
Yeah, profitability is obviously a key indicator for us. I have in the past bought companies where I think they're going to turn profitable that quarter, where I have pretty high conviction they're going to turn, because catching that turn from unprofitable to profitable, not surprisingly, you get a lot of investors that are coming in around that time. Some want to see a quarter or two of profits, and some will come in right at the turn. We have done it in the past. I think the thing people have to remember is you don't always have to be super early. Like going back to the Source Energy we just talked about, you didn't need to be that early and buy it at $1.50 like I did. You could have bought it at $3, you could have bought it at $5, right? If you bought it at $5, you'd still have a triple. The business would have been much less risky, so to speak, buying it at $5 than when I did at $1.50. So I think you need some flexibility in your approach. But it's very hard to be a successful investor consistently if you don't have a framework and a strategy. I know some fund managers where one year they're buying Canadian resource stocks, and the next year they're buying European equities, and then they're buying bonds, and they're buying commodities. I just don't think you can be best in class at all those things. I think you need to specialize, and especially in a world like today where people can just buy indexes on their phone, get immediate access, people can buy options. I mean, it's almost become a video game what people have done to investing. I think you really need to have some sort of framework of analysis, because otherwise what happens is you get ideas thrown at you all the time and you don't have a way to accept or reject those ideas quickly. So by having a key defined framework, you can easily look at an idea, and I often know in about 60 seconds if something's even worth spending time on or not. Sometimes I'm wrong. Sometimes things are worth looking at and I dismiss them, or they, vice versa. But I think having that framework of analysis or that style allows you to say, okay, this is my box of what I'm looking for, similar to what I laid out for you early in our discussion. Does this idea fit in the box, or will this idea fit in the box shortly? If the idea is nowhere near the box, then don't waste your time on it.
Yeah. So in your investor pitch deck, you mentioned, quote, emerging compounders. How do you define emerging compounders?
Sure. So let's use some examples from names that have already come up in our conversation. So I think about an established compounder, let's say Constellation Software. This is a company that has an established long-term track record of compounding capital at a very high rate. And I think most investors can look at the track record and draw a conclusion that will continue for a period of time. They've earned that expectation. Then sometimes you come across companies that maybe have given you a year or two of the growth you're looking for, but they don't have that super long track record just yet. Emerging compounders are where you can make your most money sometimes, because those are still often trading at low valuations. So Constellation is our established compounder. Something like a Propel, which we discussed early on, would be a good example of an emerging compounder. And particularly now, they've given us 2 or 3 years, so maybe not quite emerging anymore, but maybe a year or two if you were looking at it and you're saying, this company's put up some great growth over the past couple of years. It's not quite 10 years. I don't know if they're going to be able to keep it up for 10 years, but based on the track record I've seen over the past couple of years, I think there's a very high probability that they're going to continue to grow the business at least 20% a year or more. So emerging in the sense that they've given us a bit of a look, a bit of a taste, so to speak, of what's to come, but not like a Constellation or a Stantec or something that has, that's 20 years of 18+% ROE.
It sounds as though from our conversation, Jordan, you have no plans in the future with your Bedford Park to invest outside of Canada. Like, there's no extra alpha you can find in small caps in the U.S. because we just continue to be so inefficient, our market.
I think we're in a very efficient market here, but I think the second piece just goes back to manager capability and skill set. I've never really invested in U.S. equities, so how could I sit here and tell an investor, or anybody for that matter, that I think I can be top decile in U.S. small caps? The other thing is, here we have home court advantage. We know the companies, we know the brokers, sometimes we know the boards, and we know investors in the company. So our ability to get knowledge, or that home court advantage, so to speak, is very, very powerful. If somebody called me up and said, hey, I got this company in Alabama, it's trading on 8 times earnings, it's really cheap, you should take a look at it. Well, first of all, I don't really know much about Alabama. I don't know if U.S. equities are generally trading at certain multiples or certain industries. I don't know the competitive landscape. I don't know where to source stock. I don't know if the laws in Alabama are about to change because I'm not following Alabama. So I think, someone sitting in New York on Wall Street, a small cap manager sitting in New York, would have a clear advantage over me when trying to look at that company. Simultaneously, if we're talking about a Canadian-based company, I feel like I have a distinct advantage over that fund manager sitting in New York. So I think in order to provide value to clients, you need to be very specialized and focused on a particular corner of the market. I think if you're not doing that, it's hard to add value because, let's face it, people can just go buy ETFs and do very well. They don't actually need you unless you're providing value and they think you can provide a return that they can't achieve on their own, or provide access to companies that they're just not going to find on their own.
No. So you're obviously, you're named #1 hedge fund for a reason. You outperformed considerably, but not every fund is perfect. If you don't mind, kind of what Warren Buffett teaches on and what he reflects on, errors of omission, errors of commission. If we can start with errors of commission, Payfair really pissed you off. Can we talk about Payfair?
Yeah, I wouldn't say pissed me off, maybe. I was a little more disappointed in myself, to be honest. So for those who aren't familiar with Payfair, maybe let's just introduce the company. Payfair had a platform whereby their customers were Uber, Lyft, DoorDash drivers, and what Payfair did was allow those drivers to get their money sooner instead of waiting for a traditional 2-week pay cycle. So you think about an Uber driver that finishes a ride, they're owed a certain amount of money. What would happen was Payfair had the ability to go into a trust account that was funded by Uber, draw down the money that was owed to the driver, and then immediately load that money onto the driver's Payfair, Visa, or MasterCard. The driver could then immediately go spend that money without waiting 2 weeks to get paid. So at a high level, thinking about the growth in the gig economy, I was really excited about this company as I started to understand what they were doing, because I don't know about you, Robin, but my use of Uber and DoorDash and Uber Eats and all those things has just grown, and I see the way my sons also act in terms of getting places and ordering food, and I think this this part of the economy is really growing. So I was really excited to own Payfair, and they had a lot of very valuable contracts. Their biggest contract was DoorDash USA, and I think I just underestimated the risk of them losing that contract. I knew there was always a probability they could lose it, but I thought it was pretty entrenched. They already had over 1 million cards with DoorDash drivers. Ultimately, as we know now, DoorDash decided not to renew the contract. It was about 60% of the company's revenue, and the stock just plummeted. The day it was announced, I think the stock was down 72%. Luckily, we had gotten into Payfair pretty early. We had started buying it around $2. That's one where we started buying, to your previous question, in the quarter that they turned profitable, just because we were looking at the previous quarters and kind of see the writing on the wall that they were going to become very profitable. And they were very profitable. They put up several good quarters, but then this news came out, stock plummeted. I decided not to stick around. We dumped our stock. I didn't want to wait to see what happened. There was too much uncertainty. Ultimately, the company was sold to Fiserv.
And that was a crazy story, because I think Pfizer, they first won that contract, that DoorDash contract, and they ended up buying Payfair, didn't they?
Yeah, they saw the value in the platform, which there was a lot of value in the platform. They had created a great platform. Unfortunately, you had very high customer concentration, which I knew was the risk, but a lot of the thinking that you need to do as an investor is thinking in probabilities, and I quite frankly just underweighted that probability, and I was wrong. And we talk about our wins, but a lot of investors don't talk about their losses, and I think it's important to do that too, and it's important to learn from that. And I can tell you, I will never own a company again that has 60% of their revenue coming from one customer, no matter how solid I think that relationship is. So I've been doing this for over 20 years and I'm still learning all the time and I'm still screwing up all the time. And I think the key is, it's not how often you're right versus how often you're wrong. The key, and Mark Mobison wrote about this, the key is how right are you when you're right? So what is the magnitude of your correctness? And one of my favorite expressions is it's not the frequency of correctness, it's the magnitude of correctness. So you could be a little bit wrong on 5 stocks and then get a Propel or a Source Energy right, and your returns will be spectacular. So, we're not here to get them all right. We're here to not be too far wrong when we're wrong. And then when we find something we really like, to have the courage in our own beliefs and our ideas to place a significant amount of capital into a name that you may be a little early on. You may have to wait a little while for other people to see. So, bringing it all together, we're not going to get them all right. When you're wrong, realize you're wrong, admit you're wrong, and don't sit and say, oh, I'll sell it when it gets back to X price, or, really everyone else is wrong and I'm right. I think a lot of this is just sort of checking your ego at the door. When you make a mistake, fix it and move on and learn from your lesson. Learn your lessons.
It's such an important lesson. And as you said, position sizing matters so much. So Payfair wasn't really a big material hit in any way. Now, it wasn't a complete 100% omission, but you had bought Zedcor very early on. You had discovered the company. But I think recently you mentioned that you completely sold out of the position. Can you walk us through that decision? Is there an opportunity perhaps to buy back in the future?
Sure. So I don't know. You seem to be hitting on all my mistakes from last year, Robin. This is the mistake segment of the podcast? No,
I'll end it here, Jordan. I promise. These are just
kidding.
good lessons, and they're not
Absolutely.
material, right?
No, absolutely.
And you're still the #1 hedge fund. So.
I'm just playing. So Zedcor is an interesting one. We were in very early, and for those who don't know the company, it's a really hot stock right now here in Canada. What they have is mobile security towers. So think of something like a car dealership or a construction site. They'll have a tower with lights and a camera. Then that camera is not only motion activated, it's monitored from a central monitoring station, and it effectively replaces security guards. So instead of having people that you're paying by the hour, you can just put a tower and it will provide security. And then you can call police or do whatever you need to do. So they're growing very fast. They're deploying these towers very quickly. We were in the stock early. We made a quick 40% return. And then at the time, I thought the valuation was starting to look a little bit high. So we sold the stock and moved on, and the stock's doubled from where we sold it. So, I think the valuation is quite full here. I think they have some backfilling to do. I won't pause the podcast to go look up the numbers, but you have a company that's trading, I think now about 250, 300 million market cap, and it's going to do something like 40 million of revenue this year. I could be a little bit off, so don't quote me on those numbers exactly, but let's just say that you have to really believe in their ability to backfill this valuation up at the current number. But yeah, we sold it early. I'm not upset. We made a quick 40%. It's priced for perfection. Watch out, because if these guys miss one bad quarter, you've seen this movie before, Robin, and so have I. When everybody loves a stock and everything's perfect and everything's roses, if there's a hiccup along the way, you will see a bad quarter. You will see the stock down 20, 30%.
Yeah, exactly. So let's go positive. One of the lessons that I think we need to explore is that, it's not just the very small companies, the sub 300 million market cap companies where you can find, the triple baggers, 5 baggers, 10 baggers. You also invest in, quite large cap companies like TFI, for example, Constellation Software. So why is that still important in the portfolio to have these larger companies there?
That's a great question. So I'm looking for growth. If I can find growth, the growth I want in a large cap, that's even better. The problem is you don't usually find large companies that are growing at 20% a year more consistently. And if you do, and it's a large cap, it will have a massive valuation. Once in a while, though, we are still able to find larger companies that meet our criteria, or more often what happens is we buy them as mid caps, and then we own them for several years and they become large caps. So you mentioned TFI. That's actually what happened in the case of TFI. We bought it, I think, around a 2 to 2.5 billion market cap, so it was kind of still in our zone. and then the stock's quadrupled since then. And we didn't have any reason to sell it, and it's continued to grow. It's run by an excellent CEO. He's a very good capital allocator. They've made some really good acquisitions, some big, bold acquisitions in the US. They're looking at spinning off one of their divisions. Anyway, I won't get into too much of the minutia about TFI, but I would say oftentimes it's a mid cap that becomes a large cap and we're still owning it. Or in some cases, you do find that large cap that gives you that growth and valuation that you want. And if you can get it in large caps, I mean, hey, it'll help stabilize your portfolio. Yeah. You can't own all 100, 200, 300 million market caps, or your portfolio will just be really volatile. If I was running my own money, just mine, maybe I could invest that way. But when you're running other people's money, you need to manage the volatility a little bit. So I like having a couple large caps in there. You may not get as much juice on the upside in a good market, but you're also getting some protection on the downside when you get into a negative market.
Absolutely. This is always tough to do, and you probably ask this a lot, Jordan, but if you were to pick your 3 best ideas for 2025, and I know that no one has a crystal ball, but what would those 3 best ideas be?
So one would definitely be Goeasy, which we've already talked about. The stock is well off its highs. It typically trades around 11 times trailing earnings, give or take. Right now we're at about 7 times forward earnings. So if you look at my numbers on Goeasy, I think I have them making about $24 a share next year, and the stock's trading around 170. So if you do the math, you're getting the company around 7 times. This traded as high as 16 times earnings coming out of COVID in that run that I mentioned. Mm-hmm. When you're able to go and buy a stock like this with that nice, consistent high growth at 7 times earnings, I think you do it all day. We've already got a full position in the fund. If we didn't, I would be a buyer of Goeasy here today. Another name that we've talked about already is Mainstreet. I like Mainstreet a lot. It's a great steady eddy. The stock had a big run last year. It started trading above net asset value. About a week ago, I noticed there was a seller out in the market. The stock traded down to about $190. I think the high was $228 last year, so about 20% off its peak. But the company is just putting out outstanding results. As I talked about earlier, everything's aligning for Mainstreet right now. You've got rents increasing, you've got vacancies falling, you've got a very nice market for M&A. So I think as a core holding, Mainstreet is also great. Propel is another one of my favorites. Obviously, we've talked about that one. Not as cheap as it was when we were buying it, but still 10 times earnings for a grower like that is fantastic. And then if we get down into some of the smaller names, one that I've talked about recently on TV is Enterprise Group, which I believe you had them on your podcast recently. So I know you know the story well. I'm quite high on that company. Again, not as cheap as it was when we started buying it at 80 cents. The stock's now at 220. But that's one that I think will give you that hockey stick growth over the next couple of years. And I'm sure, like I said, you did a podcast with them, so I won't go into all the details on that one. Enterprise is very interesting. We own 17 stocks, and I actually like all of them. I could make a pretty good case for all of them, but in some cases, we've had stocks that are just down off their highs, or we've had a seller in the market, or they're out of favor, or whatever the case may be. So there are names that I think are a little bit more deserving of new money now versus others. So those would be some of the names I would take a look at: Goeasy, Mainstreet, Enterprise. Just look down my list here and see if I'm missing any others for you guys.
Oh, sure. All right. We have some new goodies here you haven't mentioned before.
Yeah, I like the whole book. One little energy services name that I've talked about on TV as well is McCoy, which is a newer name for us and a smaller name. I still like Source Energy a lot. I just top-picked it on BNN the other day, and we've talked about it at length. So, I really like our whole book, to be honest. But those would be some of the names that I would focus on for new money if I was allocating new money today to the names in our portfolio.
So let's close off the conversation on this last question. What are your favorite investing books, Jordan, of all time that people should just go out and just buy or grab from the library?
I think I'm probably going to name all the classics that everyone else names. I don't think I have any secret books. You mentioned my time with Jason Donville, and he's a very avid reader. I think you've been in the office before. You've probably seen his bookshelves with hundreds of books.
Massive bookshelf.
And one of the best things about working with Jason was he would often just give me books to read. And sometimes they'd be about investing, and sometimes they'd be about other things. But he, really instilled in me the importance of being well-read. I had studied a lot of the guys that everyone else studies, Buffett, Lynch, so on and so forth. But then we got into some really kind of obscure investment books and things that he got into. So I don't think I have any particular secret titles that are going to blow people's minds, but I would say definitely study the greats, because none of the things that I do are really new ideas. I'm just taking ideas from some of the people that have been successful at this in the past and combining them in a way that works for me. And, I know this isn't the question you asked with respect to books, but I think it leads to another important concept, which is knowing yourself as an investor, and knowing what types of companies you'll be able to hold when things aren't going well, and knowing if you are able to have a concentrated portfolio with lots of volatility, or if you're going to freak out when the market goes down 10% and want to sell everything. So reading books and studying those who have come before you and pulling ideas that have been successful for others and ideas that you think could be successful for you, and then pulling those together in a way that makes sense. A strategy that you're comfortable with, Robin, may not be comfortable for me, and vice versa. So I think investing is very individual, and it's not like some other professions where, let's take doctors, for example. They're taught to do a certain procedure. They go and they do that procedure many times. They become good at that procedure. It's not really the same as investing. I'm going to look at a company different than someone else. I may want to buy something or like something that other people don't like. Some people may be going crazy about a company that I don't like. I mean, everybody has their own style. And I think the most important part of the journey as an investor is just figuring out what kind of works for you and what makes sense for you and what's going to allow you to be successful over time. And like I said, the ideas are all out there. So just go study the greats and see what makes sense for you, and just enjoy the journey.
Yeah, this has been a wonderful conversation, Jordan. Thank you so much. Have a great day.
Thanks for having me, Robin. Really enjoyed it.
Talk soon.
Okay, take care.